Okay, and welcome. Ari Rosenbaum here with Bill Schories at 401k Virtual Bunch. Of course, top of the hour. I always have to shill my events. We got, of course, this event in 2 weeks. We're going to have Teresa Conti from SunWest Pensions. That 401k conference, the virtual conference, we got one on October 23rd. We got one on November 20th. And then, of course, my big event in January 21 and 22 of 2021. Got Walt Frazier, and we got Dwight Gooden on day 2. So it's going to be a lot of fun. And, for anybody interested in signing up, it's still $20.21 up until Thanksgiving. So, Bill, how are you doing?
I'm doing well, sir. Getting tired of staring at my backyard every day, but been working from home since March 2nd. I think I'm going to count the blades of grass in my yard over the weekend, but other than that, I'm doing well.
Yeah, I had the conference in mid-March at Disney World. Like, I came back on Wednesday. The park closed on Sunday, and I thought, 3-4 weeks it'll all be over, and here we are in month number 7, I think.
Yeah.
It feels like I'm on Gilligan's Island. You always think you're going to get off the island, and something thwarts it, and all of a sudden it's like, we'll be like 2 years in it or something.
Yeah.
So so you got a promotion.
I did. As a result of I'm the national sales director for Invesco for DCIO. I had spent the previous 20 plus years at Oppenheimer Funds. Most of that spent as the external wholesaler for New York City. I started on the sales desk there in 1999, got promoted to the external role in 2003, and was the external up until earlier this year. After the Invesco Oppenheimer merger, made it through that process, and then the good people at Invesco, for some reason, saw fit to promote me to national sales director. So, had to pass my Series 24, which was a lot of fun. Managed to do that, and now I'm running a team of 10 senior retirement consultants across the country.
And I would have to say how we met was through
Sure.
Rich Larita, and I always people have ever read any of my stuff. So much of I even think some of these events and all that traces to my relationship with Rich. And Rich Larita was a salesperson at CBiz, then Geller Group, and that's how I met you. And I think we met after Rich had passed. He's, like I said, when I was in anytime I have an event, I always think of him, because it's like when I had the national event in Florida at Disney World, right when the world was coming to an end. Goose Gossage was there.
Yep.
And the first time I ever met with Goose Gossage, Rich was there. And Rich would always say, when I go to Keystone for the Matrix conference, Goose was there, and he remembered me. And I actually asked Goose about him, and he actually did remember Rich.
Yep. Rich was
good.
He
didn't know that Rich passed.
Yeah, Rich was good people, did things the right way, and treated everybody the right way. So it's not surprising that you have good and lasting memories of the man, because he was one of the good ones.
So you have an interest. You were with Oppenheimer on September 11th.
Yes, sir. I was at my desk on the 34th floor of 2 World Trade Center that morning. So not a fun day, but clearly I'm here. So every day since then has been a blessing, and I don't take it for granted anything since then. So yeah, it was an event that will be with me forever, but lucky enough to make it through that.
No, that's amazing. What do you do as a DCI? What do you do as national sales director? Because, it's one of those funny things where, DCIO, I knew the concept. I still, didn't really know what they did.
Sure. Yeah. The easy answer that a lot of people view DCIO as is, they help support conferences and help support events for advisors. It's a lot more than that. We're happy to do that, for the partners that we have. But DCIO, for those not familiar with it, it's defined contribution investment only. Most of the large mutual fund companies will have a DCIO sales force. And what we're trying to do is help financial advisors, and help our record keeper partners win and retain business. So, we have 10 DCIO wholesalers. They're titled Senior Retirement Consultants here at Invesco. And their main task is to help financial advisors win 401k business. But it has to be a partnership. It has to be mutually beneficial. We're not going to go in and just talk about good funds. I've never met an advisor or a record-keeping wholesaler or a TPA wholesaler who has walked out of a finals presentation and said, oh, gee, if we only had a good large cap fund, we would have won. They don't need us. They don't need us to talk about good funds. They can find good funds on their own. So the people on my team, they do not lead with investments because that is not going to help anybody win business. They can find the good funds without us. So what we'll do is we'll call on the top retirement producers around the country. We'll go through our value adds. We have tools and resources that analyze plan lineups. We'll compare managed accounts or custom models to target date funds. We have a stable value analyzer. If you're considering multiple stable value options, we can put them all in a piece of software to look at, do they have multiple wrap providers? Is it multi-manager? What's the yield? Different expense structures, the underlying securities. We'll rip apart 5500s to go through, are they failing testing? Are there 3 different share classes in the plan? So the fees might be reasonable, but the manner in which they're being collected isn't, because there's different levels of revenue sharing. And is that record keeper, rebating the revenue back to the participant? And what I mean by that is not to the participants, but to the participant, singular. Because if I'm in a Vanguard fund generating no revenue and you're in an R5 share class generating 10 bips of revenue, and there's excess revenue, the person in the Vanguard fund shouldn't get a rebate because they didn't generate any revenue. So are you levelizing the fees back to the participant? And you can often tell if there's disparities in the revenue sharing by looking at the 5500 and the audit. And so we'll do that, where our job is to try to create the demand for that advisor to get their foot in the door with that plan sponsor. So we do that through market intelligence, competitive information, and the value add resources that we have, whether they're presentations on how advisors can communicate value. Ari, you had me at one of your conferences at Giant Stadium. I'm sorry.
At Life Stadium.
At Life Stadium. I'm showing
I keep on doing the same thing.
Yes, at Giant Stadium, where we presented a presentation called Priceless. And it was how can they communicate their value to their clients? And it's through what words to use and what words to lose, in doing so. So we have a variety of tools from practice management to benchmarking to, just industry knowledge. So that's what DCIO, a good DCIO partner, in their first conversation with you, they will not be talking about their funds. They will talking about how they can help you win and retain business. Now, as a partnership, it has to be mutually beneficial. So if they earn the right to be a partner with you, if they've earned the right to talk about their funds, then the reciprocation is, we've shown value to you, we've shown we can help you, here's how you can help us. And it's just a matter of consider using us in your plan lineups. And we do that with our record keeping partners, and we do that with our advisors. So
you've been in the business a long time. Yeah.
Yes, sir.
So how is it now, national sales director, you're overseeing everybody's region? Because back in the old days, you used to, handle typically the New York, New Jersey area. So how is it now managing other people rather than just managing relationships?
Well, a lot of the stuff that I'm doing wasn't in the brochure when I applied for this role. The private Benjamin route, this wasn't in the brochure. I thought, being a manager was, reviewing emails and approving expense reports and then traveling. No, I'm joking about that. But no, it's been a lot more involved. You're leading people, you're setting the culture, you're defining the way that you want things to be run and how you want people to operate. But you also have to give them the flexibility and to be themselves. I don't want 10 Bill Schories running around out there. These people were very successful long before I became their manager. I don't want them changing the way they do things. However, I'm going to, guide them and coach them a little bit if they, and it's not mandatory that they listen to me. I just want to give them my thoughts, my understanding of certain things, and they can gladly disagree. Tell me why you disagree, and I'll come around to their way of thinking, or maybe they'll see the value in what I'm trying to convey to them from a cultural point of view and a way to gain partnerships. One of the things I think I did very well with my advisors in the 20 plus years was become a trusted partner. It's one thing to be viewed as a technical expert, which in our role, we should be viewed as technical experts because we're specialists. We focus on the retirement plan landscape. But if that's all we're viewed as, there's another level above that, and that's a trusted partner. So I'm trying to get my team to go from technical expert to trusted partner and manage the bandwidth, because you can't be a great partner to 200 people, but maybe 10% of that number, or the advisors that you really want to engage with. Those are the people that you want to go to the next level with. Be that technical expert, because I struggled with that. I had so many advisors say, oh, Bill, he's my retirement guy. Anything retirement, I'm calling Bill. But there's another level beyond that. Hey, if I have an issue with my practice management, if I'm trying to decide, should I hire a new staff member? How do I handle this problem? Hey, I have a problem with some of my investments. I want to be that call. That's a trusted partner, where you go beyond just your job description.
What makes a great person in a DCIO position, handling a region? What type of person do you see? Because, I always say that, I work for law firms, and just because you're a good lawyer didn't make you necessarily a good managing attorney. Yeah. What makes somebody a good DCIO rep?
Yeah, sure. Very simple, and I'll give you two analogies. It's putting the client first, not yourself first. You have a low I quotient, and what that means is it's not about you, because anybody that goes into a meeting and uses the word I multiple times doesn't have the client's interest in mind. So there's a holiday movie, a Christmas movie called Miracle on 34th Street. This is a really corny analogy. But in that movie, Santa Claus gets fired from Macy's. And if you're familiar with it, the reason Santa Claus gets fired is he was sitting, in the chair, and the kids were coming up, and a woman came up to him and said, excuse me, do you know where I can find whatever item she was looking for? And Santa Claus looked at her and said, no, Macy's doesn't carry that. You need to go to Gimbel's. And the manager was standing 5 feet behind him and went ballistic and fired him, for sending the customers to their main competitor. Well, it turns out it was the best thing that ever happened to Macy's, because the woman, spread the word that, hey, if Macy's doesn't have what I need, they'll tell me where I can find it. So I'm always going to Macy's first. So that's what I try to do with my advisors. I'm Santa Claus, come to me first. And if I don't have what you need, I'll say, hey, you know what? Call the person at MFS, call the person at Mass Mutual, at Voya, they will be able to help you. And then what happens is that the advisors started calling me for everything, because if I couldn't help them, I was able to tell them who could. So I always kept two things in mind. The financial advisors, the record keepers, they didn't have to call me. And I recognize that. So after the call, I didn't want them to regret that they called me, and I wanted them to call back. And if you keep those two things in mind, everything tends to work out. So, it's that simple. It's not rocket science. You just put the client's needs first and yourself second, and they appreciate that. You don't come across as a salesperson when you're doing that.
You've always been a great resource for people. How do you, I always find it difficult in my position where somebody, it doesn't happen often, but, somebody who kind of abuses the resources and just, it's kind of like, how do I say it nicely? It's kind of like feeding a slot machine and it never pays out.
Yeah. We all have those people in our professional lives. I see Russ DeBonis is on the call, and I'm waiting for him to smile at that, because we were discussing that very thing earlier today. That there's a financial advisor we deal with that is that slot machine that never pays out.
Right.
Unfortunately, there's a universe of people on both sides, in any industry, that will look at value adds, that business partners, as resources to be exploited and not develop partnerships with. And it's a difficult call when to fire that person. In my entire 20 plus year career, I think I've fired 5 financial advisors, and not that you send them a note, don't ever call me again.
Yeah.
But this particular person, I will never proactively call them. I will never proactively email them. If they call me, if they email me, yes, I'll take the call. I'm not going to be rude. But then at some point you have to have the conversation and say, listen, this is a partnership. This is how I earn a living. If you see value in what I'm bringing to the table for you, this is the expectation. And over the past 18 months, this is the business I've gotten from you. And that usually can be a very short discussion, because there isn't any. But meanwhile, here's some other partners that you view as people, as your peers, and I'm doing the same thing for them. And this is what they've given me. So can you at least tell me, for the people you are giving the business to, what are they doing differently than me? How are they being a better partner than I am? And you put it back on them to explain. Because I find if you ask it in that way, hey, if you're giving business to somebody else, what are they doing that I'm not? Help me get better at my job, that I can be a better partner for you. And that usually stumps them. Oh no, you're doing everything, that I could ever ask. Well, where's the other side of the coin then? But yeah, it does happen, but you have to do it in a professional way and turn it around on them for them to provide that answer.
So you've been around for a while, so have I. And,
Yes.
back in my days at
Harvey,
Geller.
you keep referring to that theme that we've been around for a while. So,
Well, I speak for myself,
okay.
because today's my wife's birthday, and I think of how old she is. So, she's a little bit older, so it dawns on me that I'm going to hit that magical number in about a year and, 7 months or whatever. 20 some odd years ago, or like the Geller days, even going back 10. Well, I left Geller a long time, even before then. I think 07. Those days, how has the business changed? Because I remember those days. I remember the days where Christmas time, people got lots of gifts. And, back in those days, somebody using an index fund lineup, the plan was expensive because, there was no revenue sharing. How has the business changed? How has the business change impacted how you work in the space?
Mm-hmm.
Let's be honest. We know that management fees on, my first mutual fund was the Kaufman Fund, and it was 269 basis points, I want to say, in those days. How has the business changed over the last, 10, 15 years?
Sure.
How do you manage dealing with it?
Yeah, I mean, that could be an hour-long answer. So you mentioned gifts and business entertainment. That's changed. Just as an example, Merrill Lynch made big news last week where effective immediately, they will no longer allow their advisors to have anybody from an asset management firm or wholesaler buy them lunch, coffee,
Wow.
golf. You can't go into a Merrill branch and do lunch meetings anymore. They have cut off all forms of entertainment and dining, and it's not COVID related. This is permanent. They will not allow an asset management firm or a record keeping firm to entertain in any way. So if I wanted to take a Merrill advisor for a cup of coffee at Starbucks or go to the Carl Place Diner, cannot do it. They have to pay their own way. So with Merrill, no golf, no sporting events, that's done. So that's a big change. So it's more critical than ever that as a consultant, you have to be viewed as a value-added partner. There's 2 types of wholesalers. There's relationship-oriented wholesalers and value-added wholesalers. The best have a good combination of both. But there are plenty of wholesalers out there that are just relationship-oriented. They're at the Paramount, 3 nights a week up in Huntington. They're playing poker. They're on the golf course all the time. If the other wirehouse firms follow Merrill's suit, those days are over. You have to be viewed as a value add, as a business partner. For me, it's almost a blessing that I covered Long Island for 20 years, but lived in New Jersey, where I still am, because I couldn't go to the Paramount 3 nights a week and do that sort of entertainment. I'd take somebody to lunch, have coffee for breakfast and so on. So that's been a big change. In terms of the expense structure on the investments, it's 2 words. It's fee compression, and we've seen that going on throughout the industry. It started, with active and passive, and that's still going on today. And for the first time this year, the amount of money in passive has exceeded active. And it used to be 20% of assets were in passive and 80 in active. And that slowly eroded, and now passive has more. So, fee compression started there. The advisors then would say, hey, I'm going to lower your fee. They moved their clients to passive funds and ETFs and said, look, I lowered your fee, but they kept their comp the same. Now their comp is starting to come down. The record keeping industry is under, a lot of fee compression because of that. And now you're seeing more and more record keepers go to the fund partners for more money. They're launching, partnership programs. They're demanding more money to be on the platforms. And it's not just revenue sharing, the sub-TAs and the 12B1s in the funds. They're looking for more firm support payments. So, at some point, there's not going to be enough revenue for the fund families to continue to support this, because we're under fee pressure as well, because there's more money leaving active and going to passive. So at some point, the industry is starting to cannibalize itself, where the advisors, are going active to passive, the record keepers are looking for more, and the fund families are the last, place for revenue to come from. And we're running out of options, in terms of how to generate that. So it's an ongoing problem, but it's going to continue. And that's why it's more critical than ever that you develop a value proposition for yourself, whether you're an advisor, a record keeper, or a TPA, because if you're viewed as the low cost option, at some point, somebody will undercut you by 5 basis points or $500. And if that's all your client recognizes you for, you're done. We've gotten to the point where it's like Earl Scheib, from years ago. I'll paint any car for $19.99, or DirecTV versus Comcast. I'll do it for $18.99 a month. I'll do it for $17.99 a month, $16.99. And that's a death spiral. So you have to get out of that and demonstrate your value.
So many advisors, especially going the 338 route or going the index fund route, I find that that's always, I wouldn't say it's an easy way out, but as a 338, it's a good way of managing your risk. Why is it a mistake for everybody to be all index?
Sure. Now, Invesco is the 4th leading provider of ETFs. So we are a major player in the passive and indexing strategies. However, we also manage, hundreds of billions in actively managed funds. Our firm is 1.3 trillion in AUM. So we are one of the largest asset managers out there. We see it all the time when advisors get proposals from some of the record keepers. Look, your average investment expense is 11 basis points. And, I look at that and go, how is that possible? Well, look at the menu. It's a menu that's never been used in the history of investments. It's 19 index funds. 20% of the assets are in the fixed account, which has no expense. And if that's the case, please pay me the gross and not the net. But that's what's being portrayed to win that cost argument. And it needs to be done because so many people are just looking at price. But the object of the game isn't he or she who pays the least. The object of the game is he or she who retires with the most. Lowest cost doesn't always mean best. In the hundreds, if not thousands of plans that I've been involved with, I found that most plan sponsors don't want the lowest cost plan. They want the best plan. And a healthy mix of active and passive is the way to achieve that. So what's wrong with an all index lineup? Well, let's look at that. If you index large value, large blend, and large growth, your large growth index has 55% overlap with the blend, and your value index has 45% overlap with the blend. Same thing in mid and small. So you have 3 index funds with 100% overlap across the board. So you lack diversification. Second, almost all indexes are cap weighted. Over 25% of the S&P 500 is in the top 7 names. So the market right now, from a cap weighted point of view, is extremely concentrated. You're not diversified. And it's a self-fulfilling prophecy. The more money that goes in, the bigger the top stocks get, because most of your money is allocated to the bigger ones. The bigger they get, the more money that goes in. The more money that goes in, the bigger they get. And it's going to work the same way on the way out. So equally weighted might be another way to consider indexing, but there's also plenty of categories where historically active has outperformed. You look at fixed income. Most fixed income managers do manage to beat the index. International, tends to beat the index as well. And it's not that the managers in those spaces are geniuses. It's the problem is the index. If you look at the MSCI EFA, it looks like the US stock market from the 70s. It's banks, it's railroads, it's utilities. There's not a lot of tech, there's not a lot of healthcare, there's not a lot of the companies that are innovating because that index hasn't been adjusted in 30 years. So it's very easy for international equity managers to outperform the index. So yes, you can have your low cost option, but again, the object isn't he who pays the least, it's he who retires with the most.
So do you see a lot of the advisors move to the 338 space?
Mm-hmm.
Did you lose a lot of relationships where people just said, you know what, I'm just going to go in all index and I love my Vanguard funds and that's it?
Yeah, because if the advisor's doing, has a 338 model, one, especially in the small end of the market, and that's fine. There's nothing wrong with it. But the pushback on that is we see more 321 actually, because you're dealing with a business owner that is used to making every single decision they've ever made around that business themselves, and now you're putting your hand up saying, no, I got this. You're not involved. And there's an immediate, like, what do you mean? And I actually have advisors that charge less for 338. Now, I know a lot of advisors charge more for that, but there's some, a different way of thinking about that is I have one of the larger advisors that I worked with when I was in the field said, no, I charge less. My fiduciary process between 338 and 321 is the same. I still have the same criteria. I'm still reviewing the funds the same way, but now I don't have to chase signatures. I don't have to go after them. I don't have to make the pitch to them and get them to sign off on it. So if I'm doing the same work, if I'm doing less work, why would I charge more? So right. I actually have some advisors that have started charging lower for 338. No, the flip side of that as well, there's more liability. Well, either way, that client's going to court. Bernie Madoff was a 338 on the New York Mets plan. And the Wilpons lost that lawsuit. They had a $2 million fidelity bond, but there was $4 million in losses. So the fidelity bond kicked in, the participants sued and won for the other $2 million. Oh, but we had a 338. Well, you hired them. You were responsible for monitoring and reviewing the due diligence. So how did you pick this 338? Oh, well, they came with my record keeper. That was the only option. That's not going to hold up well. So no matter what, your plan sponsor is still involved. The advisor is still involved. So, with 338, we see it. It's definitely, a viable option, but we're seeing more 321, at least in the circles that me and my team are traveling in.
So one of the funny things I used to do when you were with Oppenheimer was pull out the Houston Astros 5,500. Tell us a little bit, because some presentations, they're just, depending on the plane provider, they're just not very good. And I always thought that, you pulling out the 5,500 of the Houston Astros was pretty interesting.
Yeah, wait, fastball and the garbage can. But I've been doing that Houston Astros 5,500 thing since 2009, maybe 2010. There's a long story behind why, but I won't go into that. But yeah, that goes to the point of the value that we were trying to bring in helping an advisor create the demand. I still have advisors that email me. My record keeper partners will email me, hey, can you take a look at this 5,500 for me and rip it apart? Because it shows the flaws in the plan, whether it's failed testing, multiple share classes, where dual eligibility might be a good fit rather than, just 1 year of service, 21 years of age. But going through a 5,500 a long version 5,500 really is an eye opener on what you can find with the plan. So that's just, there's no investment, that just goes to my point, how I didn't talk about investments, and still don't, even though a mutual fund company signs my paycheck, because that's not what my clients need. They don't need my help finding a good fund. That's how I earn the right to talk about my funds.
Yeah, you're not exactly Stedman. Remember the Stedman funds? They were always the big money losers. I mean, you're not, you're good quality funds. Anybody can read your Morningstar profile and see that they're quality stuff.
Yeah.
Back in the day, again, we're going back to how old I am. 13 years ago, I predicted the end of revenue sharing. I predicted that the market was going to go to a fee disclosure market. Where do you see this business headed?
We're heading towards more fee compression, more consolidation. I mean, in the past week, you've seen Empower purchase Mass Mutual, Empower purchase Fifth Third. You've seen, over the past year, Invesco purchase Oppenheimer funds. This morning, you see Morgan Stanley is buying Eaton Vance. And in terms of, the fee compressions will continue. What we're seeing in the large market right now is the exit out of mutual funds, both active and passive, into CITs, into collective investment trusts, for more additional cost savings. You're seeing litigation around how come you're still using mutual funds in your plan? You're a $90 million plan. You have R6 shares. Well, that's the lowest cost share class available. Well, how come you haven't negotiated for CITs? I didn't know I was supposed to.
Right.
So you're seeing more and more of that. We're having conversations, here at Invesco with some of the larger firms right now around CITs and pricing. I don't know that revenue sharing is completely dead, but it's not well, and it's because there are instances where you have the R6 or the institutional share class, but you have instances where you can use a more expensive share class and rebate the revenue, and it winds up netting out cheaper than the lowest cost share class. So if you're using revenue sharing to arrive at the most efficient share class, that's fine because it's being rebated back to the participant. But to your point, Ari, about putting the revenue sharing just in the hands of the record keeper and saying your plan's free, those days, if they're not over, they should be, because that still baffles me. Up until my last day in the field, I would sit down with the CFO in front of a company with hundreds of millions of dollars of revenue, and they would look at us and go, our plan's free. And I would have to tell them, listen, there's no such thing as a nonprofit, in the financial services industry. So yes, you're not writing a check. They're not doing an ACH out of your account. So the question isn't how much are you paying, because you're not paying anything. The question is, how much are they getting? And where is it coming from? And that's when we pull out the 5,500 and we see, the Invesco diversified dividend R6, but then they have the Columbia A share and the Delaware R share and somebody else's Y share. And look, this fund has 10 bips, that fund has 20 bips. Oh yeah, that's why they're not charging you. So, the move is to more and more fee compression. Most efficient share class out of mutual funds into CITs is starting its march. We're in the first or second inning there, but I would expect to see more CIT launches as we go down this path.
Mike has a question. 5 years, do you think revenue sharing will be completely gone?
No, I don't think it'll be completely gone. Only in instances, where I would expect it to stay and validly stay is where I referenced if you have a share class where if you rebate the revenue sharing back to the participant and it nets out lower than the R6. There are pricing anomalies with how mutual funds price their mutual funds where that does occur. That's a valid reason to use revenue sharing because it's not really being used except to be collected and rebated back to the participant to arrive at a net lower expense to that participant. But you'll always have some providers that have legacy plans on the books that are collecting revenue sharing. It's like, if you were to ask Verizon, do you think you'll still have customers on the calling plans you had in place in 2007? Will you still have them in 2021? Verizon will whisper, I hope so, because you're paying $100 a month for 100 minutes a month. So yeah, I don't think the providers will, proactively reach out to their clients and say, hey, we're giving the new clients a better deal. They'll keep them on the books as long as they can because it's profitable.
That reminds me of a certain TPA that I used to work at and the old contracts that they'd have with a certain insurance company, and they never bothered to tell them that, by the way, contract lapsed, but you're still paying like 250 basis points or whatever it is.
Yeah, it's like a cell phone. You can be like Gordon Gekko on the beach with the battery pack and the antenna. Hey, it works. I can make a call. I can get a call. There's nothing wrong with this. Well, yeah. But if you haven't looked, if you haven't shopped, and you're not aware of it, nobody's made you aware of it, you think you're fine. How many times, for the advisors on the call, have you called a client, a prospect? Oh no, nobody's complaining, everything's fine. that is not a fiduciary answer. And that's the value you bring. Hey, if you haven't looked, let's at least take a look at the marketplace, see if we can do better. We can leave the investments the same. And that's why I led with, most of the advisors we work with, you can fix it where it is. You don't have to move a plan to win a plan. If, however, we see it's so far gone, yeah, we'll call in, Russ from Voya or somebody from Empower or, one of the other partners. Hey, let's take a look at this and see if we can do better.
CITs and ETFs, those have been talked about forever as the next big thing. Do you ever see a break point where, people are going to really move into CITs and ETFs? Because, we know a certain TPA on Long Island, big on ETFs 13, 14 years ago, and I still never saw, I think I personally invest in ETFs in my own account.
Well, ETFs
I never understood the fascination behind CITs and ETFs in a 401k plan.
Sure. Well, CITs are basically just a mutual fund in a different wrapper and a lower cost wrapper. The issue was many of the fund families had minimums of 5 million or more to get access to a CIT. It's not a registered product so it's not registered with the SEC. It's the Office of the Currency or some other federal agency that oversees them. So there's less regulatory, and that means lower expense. So what you're seeing now is the fund families start to lower those minimums or engage in exclusive pricing for some of the larger firms out there. So I expect more and more of that to happen, and that is going to result in lower revenue streams for the fund families. But we're seeing more of that. As far as ETFs, if they haven't gained traction by now in 401k plans, I don't know that they ever will. And here's why. Why do people buy ETFs? Well, I want low cost passive. Well, you can get that with the 40 Act mutual fund. You can get the Vanguard S&P 500 Admiral share for 4 bips or 4 or 5 bips. Same as the ETF. So the low cost game is satisfied by a mutual fund. They go into ETFs for tax efficiency. Well, that's a moot point in 401ks. Everything comes out as taxable income. So that advantage is wiped out. They go into ETFs for intraday trading. Well, you can't intraday trade, nor should you inside your 401k.
The only ones who ever did that were the Boilermakers Union with the funds with the late trading back in the day. Remember that?
Yeah, right. So all the advantages that are wrapped in an ETF either don't apply to 401ks or can be covered by low-cost index funds. But from a fiduciary point of view, if everything else is equal, why do I want to put a vehicle inside of my plan that could be subject to short selling by the hedge funds? You can short an ETF. You can't short a 40 Act mutual fund. So I'm going to lean towards the 40 Act mutual fund, and for those reasons. I'm not losing anything. It's the lowest cost structure, low cost passive, not subject to the volatility of short selling, and it gives me everything an ETF does. So I think that's why ETFs haven't taken off, because you can't intraday trade, you don't have the tax advantages, and you can satisfy all the low cost passive needs with mutual funds.
Imagine trying to record keep day trading in a 401k plan.
Yeah. Yeah.
All the TPAs would go out of business. They would just say, you know what, we're not going to deal with this crap.
Yeah, and from a fiduciary point of view, why would you put vehicles in there that permit that type of activity from your participants? You're giving them more rope. Hey, you gave me this toy, you didn't teach me how to use it, I blew myself up. Not my fault, your fault. You got to make it up to me. So, maybe I'm wrong, but, the ETFs really started gaining traction in 2005. We're here now 15 years later, and their market share within the 401k landscape is in the low single digits. I don't see it happening anytime soon. Maybe I'm wrong, and it does happen with some changes in technology. But for the time being, I think this is the last fortress and bastion of 40 Act mutual funds, is the defined contribution, ERISA 403B, and 401k landscape.
So do you see a lot of interest in sector funds? Because I know Greg's asking about that. A sector rotation strategy. I tend never, sector funds, you see, the social fund, maybe you see real estate, but I don't see them being popular in 401k plans.
We do, we don't see them, we see them. So the short answer is yes, we see them. Real estate, utilities, financials, healthcare, technology, those are the main sectors we see. You know, we're starting to have clients say, you know, do you have an infrastructure fund? Do you have, you know, an energy fund? So we do see demand for it. Where we really see it is with doctor groups, you know, where everybody's the smartest guy in the room. The problem with sector funds from a fiduciary point of view is that participants tend to get into them at exactly the wrong time.
Yes.
You know,
They chasing the wagon.
absolutely. We saw it in 2000. How many participants wanted the Munder Net Fund in February of 2000? You know, they jumped in for 2 months and then, you know, plunged.
The Seligman Science and Technology Fund in 1998.
Right. And then we saw
Everybody
it
wanted
with
to be in that one.
yeah. So we saw it with the tech wreck. We saw it with the real estate bubble. We saw it with gold. We see it with energy. You know, they're either doing very well or very poorly. So, you know, there's nothing wrong with having sector funds, but they have to come with a caveat, and they have to come with a financial advisor on the plan to educate the participants to say, this is a diversifier. This is a hedging strategy, something that an alternatives fund, something that will behave differently typically than the rest of the funds in your plan, and used in moderation. You know, a 5 to 10% allocation to real estate or inflation protect vehicle like a gold fund, you know, can be additive. It can smooth out the bumps. It can lower risk. But, you know, for the people that are market timing and think, you know, now is the time to be in tech or biotech, or now I want a Bitcoin fund or a Tesla fund. You know, when you go to get a haircut and the person cutting your hair starts talking about it, you know it's time to not be investing in it.
This is true. And it always reminds me of the double inverse Chinese ETF. You know, there's never going to be interest in that in a 401k plan. You know, right. It's all or nothing. Just to conclude, I always say, you know, if I'm the father of that 401k conference, you're probably one of the uncles. Because everybody, I always tell people a story, so now I can say your name and blame you. We were at an event. We were at a national event somewhere in the United States. I don't want to say which city. And we were talking about because I was in that room, you know, one of those, what do we call those rooms? Or the salon, what do you know, the vendor room, right? Or is it? And you told me
they had a name. I wasn't aware.
Right, whatever. You know, it's always the you know, the suckers who pay for the event. You know, that room. You know, to me that's. And I remember you telling me how much that the breakout room. Thank you, Tom. Always, you know, your buddy Tom Lonker.
Yep, I see it.
Yeah. So yeah, the breakout room. That's right, Tom. You see, that's what happens when you go to more events than I do. Yep. And I remember you telling me how much that little thing. It wasn't little. I think you could have rented out space in that area that you had for that fund company. And so I came to you about a year or so later, or two, and I came up with that. It was you and Chris York.
Yep.
And I came up with the idea. Originally I was going to do I thought of the sci-fi conventions. You know, the one in San Diego and all that stuff. And then I thought about sports, and voila, you said, oh, you know, you didn't say this is the worst idea I ever heard of. You went in and we had our first event at Citi Field, and hopefully we'll have it again.
Yep. No, it's, I remember that conversation well. I remember the city, you know, you're talking about. Yeah. And it's been nice to see it grow and catch on. We disagreed on a few things about the concept of it, which is fine, but you ran it and you've run it well, and it's turned into a nice event.
We worked out some of the kinks. You know, the funny thing is when you have that first event, you know, my buddy Larry had Dwight Gooden, you know, so Larry knows not to announce that the guy is there right when somebody's speaking, you know. Oh, by the way, Dwight Gooden's here. You know, that kind of hurt, you know, my buddy Dan with his last presentation. See what works and what doesn't. And, you know, hopefully this will end one day and we could go out again, you know.
Exactly.
I got to go to Yankee Stadium one of these days. And, you know, I still have events from last year that I got to reschedule.
I don't like Yankee Stadium. I'm a Mets fan. I'm more of a Yankee
fan. How about, yeah, we could conclude about our Mets. Is that the greatest thing that the Wilpons are selling out or what?
Yep. So, yeah, I mean, the Wilpons is addition by subtraction. You know, them being out is a positive. So, all good there.
Well, hopefully, you know, I'm always the pessimist when it comes to the Mets, and you know, Steve Cohen could be the second coming of Steinbrenner in the 1980s.
Yeah, no, I'm scar tissue when it comes to the Mets, but So yeah, no, this was great, Ari. I mean, I'm happy to take any questions if there's, anything more industry related. Ari, I don't know if I know it's at 4:45, but if there's any other topics you want me to quickly address, I'm happy to do so. This was great. So thank you for the people.
This is always fun. The conferences are great. People present, but to me, it's like I'd rather know like how you started. It's just it's a different, interesting element, and I'm not exactly Barbara Walters here, but
yeah, no, I've been involved in 401k since '94. So it's prior.
Yeah. You only have 4 years on me. September 8th, 1998, when everything was done still by pen and paper, and by phone.
Yeah, this is an accidental profession. Nobody in college ever said, I want to be involved in 401ks when I graduate. This is what I want to do.
Well, people always ask that question. How'd you become an ERISA attorney? Well, it's the first job I ever got. Listen, Harvey Berman was, looking for an attorney, paying me $35,000. I didn't have a job, and that's it. Yeah, Julie, classified ad. Mine was a classified ad. It was on the internet. There was a website for lawyers, and I was looking for a lawyer and Syosset, and voila, I'm still here. So
my first job, there was no internet. It was Drexel Burnham in New York City at 2 Broadway in September of 1988. So
the firm Milk and killed.
Yes.
Okay, so thank you, everybody. We'll be back in 2 weeks, and thank you, Bill. You're such a great guest.
Thank you, Ari. This was enjoyable and relaxing, and thank you for everybody. I know, we're all on Zooms and meetings. Mike, I see you there. Thank you all for taking the time to be part of this. I appreciate you taking time out of your day to listen to us and hear what
it'll be up on YouTube later today, so people who missed out can watch it again. So thank you so much.
Appreciate it.
Bye.
Bye-bye.